Let's begin this show with the market voice. Michael Ingram, who is an independent market strategist, joins us right now on the show with his thoughts. Michael, good having you. Thanks much for joining in. The last few days, a lot of indicators haven't proved to be fruitful. There may have been a golden cross for the EM pack, but the emerging markets have come off. All the bets being placed around possible resolution for trade war isn't quite working out, and we still have the commodities doing well. So where is it that you are finding favor in the current scenario in the emerging market pack?
Yeah, good afternoon. Look, it's a very difficult environment for emerging market investors, isn't it? Whilst the credit space is looking quite supportive, we've had credit spreads on emerging market debt driven down to multi-year lows, and obviously the Fed is very much instrumental in that market move. We've had relatively cheap emerging market currencies, and in recent months we've had a little bit of a help from the carry environment. But I think the real issue as far as emerging markets is concerned is simply growth. Yes, we can continue to see, by and large, disappointing soft numbers at the macro level. And in terms of the earnings per share outlook, whilst there have been some markets such as Russia, South Africa, where I think the EPS numbers have actually come up a little bit this year and into next. I mean, some other markets, South Korea, for instance, had an absolutely awful time. I mean, EPS forecast down something like 40%, and clearly some stocks like Samsung, in the at the epicenter of that. So I think the outlook is broadly neutral overall. I think you have to be sort of quite market specific. I still think that the external environment might come back into focus. And as you mentioned, you do have the spectre of geopolitical risk, which I think is helping to hold emerging markets back as a whole. It is seen as a marginal risk asset by global investors. The situation in Hong Kong at the moment appears to be deteriorating, and as you say, it remains unclear as to where we're going in terms of US-China trade. There were some very positive noises over the weekend in terms of a conference call between Liu He and Steve Mnuchin, but we've been there before more than once, so I can understand why the market's quite cautious at the moment. And I think in the absence of any break in that negative momentum on growth, in the absence of any substantial developments on the US-China trade front, I think emerging markets actually might continue to struggle.
In light of that, then, Michael, do you see money that's been lying with foreign institutional investors that probably could have been allocated to emerging markets now going back to US equities?
Well, I think that US equities have remained, reasonably well bid. Actually, I mean, I was remarking just before I came onto this show that we're now into this outlook for 2020 sort of stage of the year, and 12 months ago everybody was saying the US was going to underperform, and certainly within developed markets you should be looking at European cyclicals. That's proven to be completely, I think, the wrong call, although I guess we've still got a few weeks of the year left, but I'm somewhat skeptical. You still see the tech sector in the US, as broadly defined, still very well bid. You still see the dollar very well supported. I think the latest CFTC data suggests that if anything, speculators or non-commercial positions are rebuilding long of the dollar. So I think whilst there's a sense there that there's value in Europe, there's value in emerging markets, I think that, as I say, given the very profound geopolitical issues that are out there, given the very, very striking lack of growth momentum, EPS momentum outside of the US, I think that's helping to hold allocators back. Now, of course, we may well see a bit of resquaring of positions as we get towards the end of the year. There will be an incentive for many of these asset allocators, fund managers, to lock these profits in. And of course, we need to be aware of what happened in December of last year in terms of overall market performance. I think if you're ahead of the game, maybe that's what you do ahead of liquidity completely drying up in a month or so's time. There is the firepower there, but what I'm saying is I think the positioning would help emerging markets. I think the fundamentals aren't quite there yet.
Michael, within the emerging market basket, back home for India, macros are not looking that encouraging, especially the recent data points, be it in the form of IIP or CPI numbers, were not that great. And of course, we'll be getting the GDP numbers for the September quarter by the end of this month. And economists have already started, to scale down the estimates. Moody has changed its outlook on India. But some divergent views seen when it comes to the stock markets. We've not corrected too much. In fact, we've seen some bit of recovery in the last 1 month or so. So within that EM basket, keeping Indian macros, which are looking like they may have bottomed out, but that remains to be seen. The little flows which is coming to EM, where does India stand right now? Will it continue to receive, or there'll be more of outflows?
Well, I think, a big picture, as I say, remains broadly neutral for emerging markets, and as one of the largest global emerging markets, that's neutral for India. Of course, the way that many emerging market investors play this, particularly if they're Asia Pacific centric, is they make a decision about whether they're going to be over or underweight China, and India tends to be on the flip side of that. And in that respect, of course, it's difficult at the moment to be particularly bullish on China, given the lack of visibility that I've already mentioned. And so in a way, India, is a beneficiary of that kind of environment. You are right, however, that we have seen some downgrades to India's growth forecast. I believe if you look since April, since the start of the financial year, I think EPS estimates are down about 10% in 6.5 months or so. There is a negative dynamic. I'd have to say, relative to perhaps the rest of emerging markets, it's certainly no worse than the rest of GEMS, broad brush. But I mean, I think that one of the things that is missing in the minds of many investors looking to put more money into to India is actually the reform agenda seems to be stumbling. I think that some of the recent, should we say, political moves in India don't really help sentiment. They've already been rudely reminded how this can turn against them in what's going on in China, Hong Kong. And so I think that's keeping a bit of money on the sidelines, quite frankly. And another thing, by the way, that you mentioned was inflation. I mean, I think you do have this disconnect between headline and core CPI at the moment, them going in different directions. So, of course, there is a lot of speculation as to what the RBI's next move may be, with, I think, opinions quite evenly split between rates on hold and on a cut. But, of course, a cut in interest rates, the capacity for emerging markets generally to cut interest rates, I think, is one of the things that might well be a support, though, of course, there is a bit of a backwash in terms of local currency performance.
Right. Great to get your thoughts, Michael. Thank you so very much for spending some time with us this afternoon here on BloombergQuint.